I wanted to talk about. I don't know if I went off on this rant last week. I don't know how I forgot this. I just don't remember doing it. But if I did, sorry. But I wanted to talk a bit about convexity. And there was an article out. I thought it was last week about convexity and how CTAs are no longer doing their job of helping stocks when stocks sell off. And that is our primary job, of course, not to have a good diversified portfolio where we have a standalone product to make good money for our clients and ourselves. Nope, you're wrong. It is how do you fit in? If I allocate 5 or 10% of my portfolio to you, which is idiotic, then I need you to make a lot of money for me when stocks go down. And you're not doing a good job of that. I'm summarizing this paper, quote unquote, research paper. Um, you're not doing a good job of this like you used to because you're trading too long term. You know, if the S&P makes a low and starts to sell off hard, I need you guys in there. Like, don't wait for the 100-day low or the 200-day low. It's not good for me. Try the 50-day low. Get in very quickly, and not just with stocks. If you're going to go short S&P and the indices, great. But sometimes, being short some commodities or currencies or something like that is going to help offset this dysfunctional portfolio I have that's only long stocks and maybe long some bonds. And so I need you to take this basket case of a portfolio that's totally inadequate for risk and for the future, and you do the job with my little tiny allocation for me. And then, of course, um, this is a fault with CTAs, and there's other CTAs who call out CTAs as well, because this is what they perceive their job to be. They're able to get long and short quicker than long-term trend followers, and it's a marketing thing. I'm doing this, and you're not doing this, so I'm going to hold you up as CTAs who no longer do what they should be doing, so I get more assets. But then there's a lot of CTAs who do claim that this is their job. The majority of the large ones, let's say. And so they're sympathetic to this idea. And of course, the whole problem is a trend following system with an exit at the 50-day low is not that good, or an entry at the 50-day low. It's not that great any longer. And it's much better for us CTAs who we care about our account, we care about our wealth, we care about our clients. What's better for us is trading longer term. And so anyways, this kind of drives me crazy that we need to get rid of this idea that this is what we're on this planet to do, is to help out the stock portfolio. And we need to let these people who think a long-only stock or long-only stocks and bonds is an optimal portfolio, they're the ones who need to be investors with a vast majority of their money in a long-term trend following program. There you have it. I know I left some things out. It makes me so mad. Convexity is not something we should shoot for. And I thought I had a negative critical article about convexity that I was going to tweet, but I can't find it. So anyways, there's more. I listened to the Rich and Neil's Top Traders Unplugged podcast, and I have some things to talk about on that as well. So many great things out there on Twitter and my account, topics to talk about. I'm going to scroll through here as we talk to make sure I don't miss things I like. But yeah, so I'll open it up. But another thing I wanted to mention was maybe Richard can chime in on this one. So I don't know if I got this one wrong. It's a minor point, but I wanted to bring it up. I may have interpreted this incorrectly, but okay, so this comes from the Top Traders Unplugged with Richard and Niels. And I don't see Niels on here. Okay, Niels is going to sneak in and correct me. But anyways, Richard says, so I had to edit this down a bit. Richard goes, I'm very selective in the types of trends I participate in. I look for markets to exhibit exotic, interested. And Neil says, well, that is a little bit contradictory to one entry, one exit, and a stop loss. I think that's what his point was, is that if we're waiting for this exotic behavior before we get in the trade, then that seems counter to Jerry's idea of, well, I have one entry. And then my point was, no. The one entry, the 200-day high, the 150-day high, the 100-day high, whatever our entries are, that is exotic behavior. What do you think?
Exactly, Jerry. So, good day, everyone. Great to be here. It's a bit cold over here, so I'm freezing at the moment down here in the southern hemisphere, while you guys are all enjoying the warmth up in the northern hemisphere. But look, yeah, that when we refer to one entry, one stop, and one trailing stop, it's important that when we talk about the entry, um, we're seeking entry diversification, and specifically, we're seeking entry diversification when market behavior is not normal, when price has to really stretch. So, in other words, if you could imagine when we see a trend emerging on our screens, we don't immediately, activate our trend following signals. We wait till that trend becomes material in nature with our entry deliberation, and then the entry itself will ultimately trigger entry into that trend, to participate in that trend when things start getting serious. So what it's doing is it's saying, let's delay our entry until we start heading in price towards more extreme regions, or the tail regions of the distribution. And so I agree, Jerry. All of our systems really, when you look at what that entry means, it is being specific in the trends we participate in, particularly through our breakout methods. This is different to, Andreas Klenau in his trend following book, where he was toying with trend following systems that are in the market at all times. In other words, they're either long or short, and they're turned on all the time. They might use a moving average to signal when they're above the moving average to be long, and when they're below the moving average to be short. That means that they aren't being specific in the trend, and they're capturing all types of wiggliness in the market data. But with our breakout technique specifically, we are waiting for price to do something extraordinary before we even get interested. And I think that's a much more sound basis with a strategy that's seeking to exploit outliers than a trend following system that's on all the time and is therefore capturing aspects of mean reverting behavior, all of the market behavior. We want to be selective in that region of participation.
Hi to everyone. I had a little program issue in the beginning of our discussion, maybe for 7 or 8 minutes. Now it looks like it's okay. I want to say that's a very interesting topic with this entry, with this breakout, because breakout on entries, because and Moritz said this and Jerry said this. There's Niels, as I remember, said this, that breakouts. It's very important to have these periods of being flattish. I remember that Moritz said this, certainly I remember this, that it's very important this to be flat, in a flat environment, to be flattish and not to be involved in trading process. And Richard said this right now, and I fully agree with this.
Yeah, I remember, so when Richard talks, this is a lesson for everybody, listen very carefully. Very, very carefully. And so, see, I have an advantage because I listen to these podcasts, all of the top traders podcasts. I listen to them multiple times, and then I wait for the YouTube transcript to come out. I scour over them. But I remember being very interested with, I think Richard and I do it a bit differently. So like, I'll have 4 different entries, and and the shortest term one is, shorter term. And so it's not as waiting for an extreme breakout as the longest term system. And then, so, I like that. It gives me diversification. But I was very intrigued when Richard spoke for the first time about mostly having just one entry for all the systems, a very long-term breakout, one that I totally accept, and then multiple exits. And I thought, yeah, that's pretty good. I see where you're going with that. It's to stay above the fray, get away from as many random noise and blips up and down that you can, and then when your entry gets hit, you're in. And I guess it just sounds like, well, if you're talking about some sort of exotic behavior, is that really this entry signal that we have, this kind of normal breakout? And I think, yeah, from our point of view, this one entry is signaling exotic behavior, and putting us in a situation where we're trying to avoid the noise, but at the same time, hey, it's now or never. This thing may be going. These big, huge moves are going to pass through this, and let's get our position on and get ready. So now's the time. I mean, now's the time for some of these breakouts that are occurring, especially in stocks and stock indices. So we have to be ready to see what's going to happen with this stock market.
Yeah, Jerry. And look, there was I was doing a few tweets about the philosophy of why we wait for things to get material in nature this week, and I was discussing how I think Alpha Simplex put out a very good article this week about trend following doing very, very well during periods of uncertainty and not so well during periods of certainty. And that got me thinking in relation to what do we mean by certainty and uncertainty. And the way I'm viewing things at the moment is that when we talk about market certainty, we're talking about a market that is effectively predictable in nature. In other words, it has certain characteristics that allow us to basically define that market behavior as being a regime. So when markets are in these regimes, there is this predictability about them, this degree of certainty about them. And really, when you look at what is the underlying principle driving that regime? Well, it's a tendency for a market to operate about an equilibrium. And so a particular regime is when it gets into a stable pattern or characteristic that allows you firstly to be able to describe it as a particular regime, but these characteristics are associated with this tendency towards equilibrium. That's not what we are targeting. We are targeting outliers, which are transitions between regimes. So in other words, a model, a predictable model, is trying to use history of a regime as a basis to interpret how that future is going to unfold under that degree of predictability. That's predictive models such as mean reversion, such as value investing, such as all of the different types of convergent models we see, is trying to exploit this characteristic of a market, a regime. We are trying to exploit the transitions between regimes. That's when the transition is when things become uncertain. So everything in that regime is certain, but when the transition occurs, uncertainty prevails because that prior predictable regime is no longer in force. In other words, the models that we use to exploit that regime no longer work in a period of transition between regimes. So the market behavior that occurs during that period of unpredictability is that because those predictive models don't work and the bulk of the markets or the models participating in a market are regime dependent, that means that suddenly these people, these participants are forced to drop their models and go to a behavioral response, which is classically fear or greed, to extract themselves from that situation. And that's where you get this magnificent amplification in participant behavior, because they're all becoming synchronous as opposed to all of the different models that are being used to exploit a regime. They suddenly become all coordinated, either long or short. So price can only go two ways, either long or short. And that sudden sort of massive shift in participant behavior towards behavioral response creates these magnificent transitions where you get these extended trends occurring. That's the region we want to be participating in for our outliers. So that's where uncertainty is where we capitalize with our trend following models, because we actually have a model that is designed to capture that uncertainty. Cut losses short, let profits run. It's not being predictive in any shape, way or form. It's just exploiting this directional bias that occurs when the participant behavior all becomes synchronous in nature.
Hi, Richard. How are you? Can I ask you a question about that? Because I always thought of trend following as a system for risk-adverse investors, people who want to participate on the market, but they also care a lot about the risk, of course, given a reasonable amount of leverage. And I was listening to you when you said that you thrive when there is a lot of uncertainty. We thrive when there is a lot of uncertainty. And does it make sense with my thought about being risk adverse and at the same time getting good results because of uncertainty, when uncertainty is supposed to be against people who are risk adverse? Or am I totally wrong and trend following is not so much for risk adverse people, and I'm thinking this the wrong way? I don't know if it makes sense.
Yeah, no, it does make sense. And look, just to put it into perspective, I'm an accountant by background, and I know Jerry's an accountant by background. And really, I think Jerry and I are probably extremely risk-averse people. We don't like taking losses. So we demand that our models actually mitigate risk for us, as opposed to any form of predictive assessment or our, what our brain tells us. We extract that from our thinking processes because we let our system and our rules of our system make those decisions for us. And I think that is a characteristic of a very conservative personality who doesn't like taking risk. So, but this is where the rub is. This is why we can attack uncertainty so well, because we've got risk mitigation methods inbuilt into our system, as opposed to methods such as buy and hold, that is just a means of entry. There is no risk mitigation in that. You are forced to accept what the market gives you. We say, no, let's adopt system rules that therefore restrict the adverse risk, but leave ourselves open to any upside. So we love upside because there is no risk to it. To an accountant, that's just profit. And we love as much of that as we can possibly get. But to an accountant, we hate losses. And we want a system and a method that basically is incredibly conservative. And I think we are.
That's right. We're taking these small losses. We're maximally diversified. And then when the uncertainty comes, we have on the right position, short yen or long crude or whatever it is, and this uncertainty kicks in. Well, now that we have this uncertainty, aren't you very worried about this uncertainty? Oh, no. I have a very small position on. I'm trading hundreds of markets, or as many as I can. I'm betting small in every one. And as long as it's a profit, I'm okay with that uncertainty. But as soon as that trade turns into a loss, even a small loss, my predetermined stop loss is going to kick in, and I'm going to really have two personalities. If I'm losing money and it's uncertain, I'm very nervous. If I'm making money on a trade and it's uncertain, not nervous at all.
Yes, but I think it's very important for us to understand that uncertainty is a necessary quality of our world. And I love trend following system strategy very much because trend following is adaptive for the uncertainty. And it's suited maybe for that uncertainty. And we can, like, as Niels said, that trend followers make money in periods of time where always looks certain, and in trend followers also makes money and I think even maybe more money in a crisis environment, which is a very big benefit of trend following system.
One of my biggest concerns is adopting a premise based on market behaviour. So, in other words, making an assumption that because a market has done something in the past, it's going to do it again. See, that's where I think risk lies. This is the sort of the Warren Buffett story. When the tide goes out, you find out who's swimming naked, and that's because we are so. As human beings, we are so prone to biases. So, if we sort of trading in an environment for the last 10 years where everything's been going up, our assumption is that it's going to continue to go up. We haven't been sort of privy to those market regimes where things have acted differently. And therefore our models, we get so cocksure in our models that not only do we develop models that are responding to that regime, but we then start leveraging them, increasing the leverage in those models because we're so cocksure. And this is where risk unfolds with trading systems. And this is exactly what a classic trend follower goes exactly the opposite way in everything they do to never adopt those biases that cause those principles to unfold and increase risk exposure and threaten your capital.
Good morning, Moritz.
Hey, good afternoon. Or good morning. How's everybody?
Cold.
Great. Warm. Tampa, Florida.
Very warm. South Russia. Black Sea coast, very warm.
Yeah, good. Glad to be back here. I was just trying, listening in. Maybe you guys continue for one or two more questions, and then I'll chime in. Just trying to find my rhythm here.
Yeah, I was listening to a podcast yesterday of some really smart guys, and I think they dabble in the trend following, and they definitely are the quants, quant trend followers. I mean, Richard's a quant, but he's taken his quantness and bowed down to trend following, and that's rare. That's rare for the smart people to acknowledge the power of the trends and diversification and the outliers. But it was like, in listening to them, they didn't talk a lot about their trend following ideas, but it was like whatever has happened in the past in a market or a sector, that's gospel. This is what I was picking up on. Like, yes, I mean, this is what has happened, and this is the edge and the factor, and this just a given. Commodities don't go up over time. Maybe gold. Yeah, maybe we can include gold. And this is how you mine this alpha and beta, and these things are just going to occur. And then when I have disagreed with that sort of mentality from a trend following point of view, people say, wait a second, you're paying attention to the past more than anyone. You're doing these back tests, and you're assuming that what has happened in the past 30 or 40 years, I used to say 20, 30, but as I got older, I realized it's 30, 40, is going to continue. And so the difference really is that we apply these trend following rules and systems in the back test on all the data, and we go for this thousands of trade sample size, and we take away from that, this breakout is better than that breakout. This breakout works, this stop loss works, this trailing stop works, but none of the individual market behavior and activity is to be expected in the future. What happened in the markets and the currencies and energy in the 70s, 80s, and 90s, I don't know if that's going to happen. What's happening in the markets today may never happen again in the way these markets are moving around. But I will rely upon those breakouts, irrespective of the fundamentals and the realities and the history of what happened in the markets. And so it's a much different takeaway. And in some ways, we're trying to take away as little as possible from history. Here's a pretty good place to buy. This breakout's a pretty good place to buy. Here's a pretty good place to exit. And this stop loss doesn't get us out too quickly. It doesn't keep us in too long. And we're able to keep our losses small. And that's it. Nothing else.
Yeah, I agree with that. And by the way, funny anecdote towards that. There was yesterday I received an email Google alerts. I have all these Google alerts in, so I systematically search for terms that interest me, such as CTA and trend following and these type of things. So this morning I get a message from BNN Bloomberg, and their headline is "Market crushing CTA quant firms are now facing tougher times ahead." I was like, well, that's interesting. Why is that? And really the only reason they gave is because the New Edge CTA index, or one of the CTA indices, has had its first very minor negative monthly performance in May of this year. I didn't have a negative May. I had a slightly positive May, but only because May was kind of like down a few bips. They're now saying, okay, now the game's up. Now it's game over for the CTAs because now the markets have changed and they're facing tougher times ahead. Isn't that funny? As if they knew, right? So that gets me going in the morning with the coffees.
Yeah, I saw that article, and I don't know if it was the same one or a different one. They made the point. This one was from Bloomberg, I think. They made the point that the money that the CTAs have made recently, that was the easy money. Now it's going to get hard. You could see all of those trends coming. Okay, we'll give you that money, but just admit that it was pretty easy and obvious. But now it's going to be less obvious. I'm just shaking my head.
Yeah, that's right. Other news maybe, and maybe you're not so in the weeds with that. I'm talking to a lot of systematic trend following firms, companies, upstart managers in the crypto space, trading just cryptocurrencies. They're trading usually the 20 most liquid because they need the liquidity. So that's Bitcoin and Ethereum, and Litecoin is still liquid, and Avalanche and Polkadot and Solana. Maybe you guys know that or have heard these terms. And the returns look pretty good. Shorting is an issue with some of these, which is a problem, right? Because we'd like to be long and short and not favor one over the other. But really, there's now about 100 systematic trend following emerging managers in the crypto space. Probably spoke to 80 of them briefly, just figuring out what it is that they do and maybe doing something together. Doesn't look like it, but just as an FYI for you guys of what I see there is there's like 5 to 7 who I'd say are like grown-ups like us. They have an understanding of the space. They know how that works, position sizing, risk reward, all of this. They get it. All the other ones are machine learning, AI, completely over-optimized guys. So younger kids, I don't know, between 20 and 28 years of age, and they completely don't get it. It's amazing. Like they even mention, the turtles and breakouts, and they know all of this, and they completely butcher it up. There's like nothing left when they're done with it. They do like everything that probably you're prone to do when you're young. You look at this and you think this is too easy. You need to do something that's special, and then they just completely destroy it. It's amazing. So they show me these spec tests, which obviously look amazingly fantastic. But when you ask them questions such as what is the average win, average loss, they just don't even have the answer to that. They completely succumb to the AI and over optimize whatever they can get in the data. So it's kind of amazing. There's really only, like I said, between 5 and 8 solid trend following firms now in the crypto space, but not more than that. It's still a very young space, or very, very small space there.
Yes, I agree that crypto space often looks funny, and once I get mailed from a crypto, a girl. She's a crypto trader, and she said to me that she can teach me to be a crypto trader. And I asked her questions about parameters, and ask what is your average drawdown, what is your profit, and she said, I don't know. She said, I don't know what is my profit, what is my drawdown. I have so much money that I don't want to think about the things. And it's looked really very funny. And I saw an advertisement of a crypto guy that a few days ago, somewhere in internet, and he right there, crypto trader right there, that he have no drawdown at all because he knows how to predict the market. And so it looks like it's not a trading area at all. It's not a business at all. It's something magical. All these advertisements. And of course, if they had 30, 40 years or 50 years track records like trend followers have, it would be amazing. But it looks now that really young guys don't understand what they are doing and think that we have loss of investments, loss of business in general, loss of nature in the end of the day. And here I see that such people do something and promise something that lies maybe against this laws.
Yes, same thing over and over again. Never changes really. It's a good thing probably too. I think we're in a good space. We're in a good spot.
Yeah, no, and so it's maybe it's like in the media now it's very popular to be a crypto guy. Maybe 50 years ago it was very popular. Not 50, when before the Great Depression it was very popular to be stock only. And yesterday one guy, for example, asked me that is it good to be a stock buy and hold, and we all know the answer. And of course I told him that it's better to buy if you want to be a passive only investor, not non-diversified investor. It's better to buy physical gold and land where you can land for farms, so where you can grow the food. I remember that Richard said to buy a good gun. So it's a joke maybe. And so I think that a lot of people not only in crypto space, but in the modern world, a lot of such advertisement of easy money. And people in the modern world like not processes of making money, like not to think about how does that money-making machine works, mechanism, nothing. People like it, and they, such investors, invest in such guys, crypto guys, for example, also. And as I remember that crypto guy I have talked about a few minutes ago, the advertisement of him I saw on the internet yesterday maybe, and he said that it was very, very funny. He said, I don't have 15% year profit. I have 1,500 year profit, and I don't have any drawdowns because I know what the future will bring me. So here we see the situation.
Hey, hi everyone. I've been having some connection issues here. Try to make it fast before I'm dropped again. Yeah, this thing about foretelling the future is we find it every time and everywhere, and it connects with a point Richard was making before, that trend following explores regime transition. I've been reading about that adaptive market hypothesis, not the efficient market hypothesis, and it states that markets are efficient sometimes, but at other times it transitions from one state to the other. And from what I get, we trend followers have a great time exploiting that transition, and we stay alive during the period when market is in one state and not making a lot of profits at that time. But then Jerry tweeted an article from risk.net, I think, that states that trend following does its best when uncertainty is high or when uncertainty is low, but not that much when it's going down. And it got me puzzled. I couldn't read the article completely because it was behind a paywall, but I would like to get your impressions from it. How does it make sense for you that trend following makes money when uncertainty is low?
I didn't understand those articles. I think that the risk.net was a tiny blurb about the paper from Alpha Simplex that Richard mentioned earlier. And it seemed to me that it was contradictory. I couldn't really understand either one. I was trying to be a smart ass, and I said, like, I'm not familiar with these periods where uncertainty is low. I mean, I'm always uncertain. I don't care about certainty or uncertainty. And I'm behind that. I don't the subscription to risk.net is thousands and thousands of dollars. So you can never read very much of what they write. But I wasn't really intrigued by either that article or that paper as to when and where trend following is going to do better or worse, maybe in hindsight. But I really would never try to confuse my one entry, one exit, and a stop loss with trying to anticipate, is this a certainty period or uncertainty period? Should I go quicker? Should I go later? What should I do? I think most of these things are very interesting to read, but then we ignore them and we go back to one entry, one exit, and a stop loss.
I agree with this, and I think it's very strange, really, to say that we have now certain period or we have now uncertain period. We can say only that nothing very maybe uncertain have happened, nothing extreme have happened for the last maybe 2 years, for example. We could say it in the previous periods. Now we can't say this. We saw very extreme situations. So, but the world is uncertain, and we can face extreme situation in every minute. In fact, earthquake, maybe, or something, or financial crisis. And we have seen all this. We have seen pandemic. We have seen wars. But it's all this uncertain, and maybe nothing. We can't predict this. And as Neil said, we can't predict that oil will be in a range maybe more than $100 for a barrel, and minus $30 a barrel, and in 2 years it was so. So this question, if we are now in a certain period of time or uncertain, in fact, we really don't know what the next few hours can bring us in our maybe personal life. We can only think about it, but we can't predict it exactly. So I agree with that. This question is strange. And so the question is strange when people say about stability, that do you have stability or something like that. And I said, people asked me about stability, and I said the stability, it's adaptivity for me personally. And if people don't have adaptiveness, they don't have stability.
If I would want to make an attempt to understand that, my simple summary would be that in extreme moments, whether it's extremely uncertain, extremely certain, trend following does well. And when it's like in between, indecisiveness, basically, it doesn't. If I translate it that way, then it makes sense, because obviously indecisiveness means whipsaws, which means a lot of losses, small losses, and in extreme moments, it's more directional. But outside of that, I agree. I'm not sure what they want to get out of that.
Yeah, look, Bruno, what I picked out from that Katie Kaminsky article, I was fortunately able to download it because I was emailed it by Neil, is that Trend following models, according to Katie's work with Alpha Simplex, tend to work well either in periods of high macro uncertainty or low macro uncertainty. But the way to view that is that we're dealing with the extreme verges of a regime. In other words, there is this predictable regime where trend models don't flourish. That's when predictive models flourish. But then on the verges, either the extreme high or the extreme low verge, that's what I'm referring to as this transition territory. It's actually not part of the regime. It's more a transition between regimes. In other words, it's where the predictable nature of a regime suddenly becomes less predictable or more uncertain. Either that's a reduction in the level of certainty, or it's an increase in the level of uncertainty that creates these spectral extremes. So I think that's what she was getting at. And that's where maybe some of the confusion lies, in that a lot of people tend to say that an uncertain market is a particular regime, but it's not. A regime is when you can categorize a particular market condition. In other words, there is some feature of a market condition that can be categorized and is fairly predictable in nature. That's why we can categorize it as a specific regime. An uncertain regime, however, you cannot categorize. It's just a transition. It's a real mess. There is no common features of that which allows you to categorize it as a particular regime. So I think we've got to get away from referring to different periods of a market as all just being different regimes, and think in terms of what is regarded as a regime or a predictable market condition that extends for a period of time, and then what is a transition. And a transition, a regime tends to be a period associated with a quasi-equilibrium. In other words, the nature of the market is predictable because it's operating around an equilibrium level. Therefore, it's predictable in nature. A transition is where we get a divergence away from that equilibrium, and that can be extreme volatility. It can take a huge array of different forms, but it is not displaying the characteristic signature of a regime around an equilibrium. And this is where we refer to classic trend following exploiting the boundary of chaos. In other words, well away from equilibrium. This is where trend following models shine, because predictive models simply can't assess the common characteristics of what's being exploited in that regime. It's exotic, it's unfamiliar, it's very low sample size, but we have a model that's able to exploit that.
Yeah, the period while this transition is occurring, I understand the reason, and well, it's what we talk about every week, right? What bugs me is this claim that during extremely low uncertainty, trend following does well. That's what I don't understand. And just to comment on Jerry's and Oleg's response to me, yeah, under the hood, everything is uncertain. I agree completely with that. It's just that, just like Oleg said, after the fact, we can pin out and say, oh, right, now I understand the reason was A, B, or C, and everything was obvious, and I'm just dumb, or anybody that didn't understand it at a time was dumb, and etc. But yeah, under the hood, the world is uncertainty all the time.
Agreed.
I really enjoyed the endogenous, exogenous explanations where 95 or 90% of these trades are endogenous. There's no news. It's a surprise. They're going to last for a year or two. Oh, I guess that's the reason my long-term trend following back test looks so good. I love that, of course. And that the other 5 or 10% of these exogenous trades, they're in the news. They're going to be moonshots, and they may crash. And then I even went so far as to ask Richard, then if it's parabolic and it's really volatile and it's in the news. Should I change my exit? Because it's not going to last a year or two. I'm identifying this as exogenous. And his response was, no, don't do that. Don't change. So yeah, listen.
You got to laugh. Actually, it's interesting. This also comes to the topic of people that use factors to try and for their trading methodology. And I've got real issues with people that do that because, and Bruno raised a really good point in his tweet this week, and I sort of supplemented it. And I think Jerry, you're involved in it as well. But this is where if you focus on factors as your edge, then it is highly likely that you're going to miss other factors or other reasons or other causal drivers that cause those outliers. So by focusing on, a particular causal driver, I think that is exactly what we don't want to be doing. And people tend to do that because they like to associate these different regimes with different factors being the dominant causal factor of them, such as an inflationary regime or something. And I think that is totally counterproductive to what our models are trying to do. And the way I'd explain that is that people that are looking to factors as the causal drivers for what makes their models get alpha, I think they run into the problem of situations where there might be a myriad of different causal factors actually all being responsible for driving that price movement. It's rare to ever see a single driver causing it. It's always a confluence of different drivers. And that therefore means you've got to measure the strength of the different factors, which one's responsible. And you can overcome all of that complexity by just recognizing that it's not the factors that are important for driving a market. It's actually participant behavior that is. And there's only two things a participant can do. They can either go long or they can go short. That's it. So what happens is you could break down all of those different factors, and I don't know how many there are at last count, but there's probably about 20 or 30 of them. You can forget about that and just think, what is the impact of price in terms of participant behavior? And if you follow that price, long or short, you are capturing all possible factors, all possible causal drivers, because it's the behavioral impact or the participant interaction of the buy and sell which is actually causing that price to move. The factor underlying it, well, a factor could be, inflation. It could be a tsunami. It could be a cat running over a keyboard. It could be Nick Leeson making a mistake at his trading terminal. It could be so many different things. But if you're really focused on the factors, you miss the point entirely about catching outliers.
I find this literature on factor investing fascinating, actually. Really interesting, actually. In the attempt to explain price movements and the market and the engines under the hood. The only thing is that it's really hard to make money from it. One thing is to find some strong relationship between a factor and some stocks or some price. The other thing is the meaningfulness of that relationship. You can pin out that the value factor is there, right? But how much does it account for price movement? Close to zero. So that's why it's so hard. And then comes that thing that sometimes one factor is more, the prices are more sensitive to some factor, and other times it's another factor that is dictating, saying the rules of the game. And then come the models of changing what's the word? Changing loadings of the factors and all of that. Actually, we don't need that. We just need to follow prices and see what's going up and what's going down, and whatever factor is behind that movement, we don't really care. Whatever it is fine. It's just that if price is going up, I'm buying. If prices are going low, I'm selling, and that's it.
Exactly. And as you know, JPB sort of mentioned, 90% of the major price moves can be accounted for by these endogenous reasons. So exogenous reasons such as news events, information that comes into the market, in his research was only 10% of major price moves. And the nature of that signal was different to those endogenous price moves. And he assigned that difference in signal behavior, the exogenous events having a much more shorter time period of major price movement. In other words, the volatility move under those exogenous moves was shorter term in nature. Might be 2 to 3 months at most, whereas the endogenous price moves might have had 1 to 2 years to play out. And of course, what is driving the difference between exogenous and endogenous is the degree of understanding of what is driving that move. In other words, an endogenous price move that arises from within the market is something that takes a lot of time to actually understand what is causing that major price move. And that degree of uncertainty means that that event lasts for far longer, 1 to 2 years, for instance, sometimes. They're exactly the levels of uncertainty in that endogenous price move. It's exactly what we're trying to target with these extended price moves of these trends.
Most of us insist to rely on our ability to forecast what's going to happen, right?
Exactly.
I remember Eric saying something, Eric Crittenden, he just has a way with words sometimes. And it really, and when I have these private conversations with Eric or Richard or some of my other friends, Moritz and Niels, and I will ask them like, oh, can I tweet that? And they're like, oh yeah, go ahead and tweet that. And I put quotes around it, and sometimes I'll try to even put their initials or something. But he's once said, when you think about it and you look at some of these big trends, that 100-day breakout was a very low price. It was undervalued. And I was like, oh yeah, I guess it was undervalued because people's mindset is, golly, you're going to wait to the 100-day high or the 200-day high to get in this thing? I mean, how far is that from the low? You can't do any better than waiting for a high price. And then, crude's at 120 or 130 or whatever. And you're like, oh yeah, crude was undervalued when you bought it. And you're like, and then how much better are they going to do? Just picture in your mind this big downtrend and a value person or someone who is looking at being tempted to buy something because it keeps getting cheaper and cheaper. Okay, so like, and you're waiting for this breakout. It's not going to be even, and this thing just keeps going down and down. And just think about, where do you think their average purchase price is going to be? You buy, it goes down another 20%. You buy some more. You keep buying Kathy Woods. You keep buying ARK. And then I'm going to buy ARK when it makes a 100-day high. So do you really think, that their entry level on average is going to be better than your little 100-day high? I don't. I think it's going to be way worse. And of course, the psychology and the money management is all wrong. It's a better trade. You keep adding to the loser, and it's better and better. And you're like, well, at some point, your brain is going, this does not feel better. This feels way worse. And they're right. It is not better. It is way worse.
You had a good statement you made under Corey Hofstein's thread, Jerry, where you said, I'll just repeat it, trend following is non-random rebalancing. I mean, what a great comment that was.
What's funny is I don't really understand a lot about what he says, but I know. And then I think he was on Twitter. Oh yeah, that's a really long thread he had, and he was basically, I think, saying rebalancing is a really good thing. It helps you make more money. And I think the way I look at it is just imagine, you're in these markets, and one of the sectors you're in, let's say you're long the commodity index, and then you're long also the S&P, and the bond index. Okay, so this is your portfolio. And the commodity indexes, they've done pretty well. And so you're continuing to get out of those commodities. I guess it depends upon your frequency. And then because they're going up and they're becoming a bigger percentage of your portfolio, and you're continuing to buy stocks. And, we're just going, oh my God, I don't like this. I'm continuing to buy something in a downtrend, and I'm getting out of these profits too quickly. And I remember I tweeted a paper that recently, it hasn't been that long ago, that basically said, this does not work. It doesn't work because you're on the wrong side of the trends. Yeah, okay. Oh, that's why Jerry tweets everything. Yeah, exactly. I mean, that's why I tweet everything. It bolsters my case. But Corey's point was, no, this actually does work. And it's required to make more money to continue to do this rebalancing. So I did not understand how his analysis would actually show that rebalancing. I mean, you're going to get lucky. You're going to get out of the highs sometimes and buy into the lows sometimes. But it seems to me at the end of the day, when I hear these things, my brain automatically says, okay, what you do know is true is the trend following thing. So reformulate what these people are saying from the trend following worldview, because that's the proper worldview. Force this traditional or this newfangled way of looking at things into the trend following worldview. And this is what you come out with, which is that no good. If you want to rebalance your portfolio, then do it based upon the breakouts. Of course, I mean, that'll definitely work. But this sort of every 6 months or every 10% or 5%, these are not methods of increasing and decreasing positions that a backtest would like very much.
We've been arguing this case for a long time, and I'll just talk about what Corey was saying. So what he was saying is that there's this recognized thing called this rebalancing risk premium, which he doesn't believe that word is the correct word because he doesn't think it's a risk premium. He thinks this is actually an effect of the portfolio mathematics that occurs when you undertake this rebalancing process. And most funds, they might do it annually or something like that. However, now this is a subtle thing, and this is exactly what we do. We actually rebalance every single trade we do because we are applying an equal risk bet across any asset class. In other words, when we are applying our equal risk bet position sizing, that is rebalancing. It's doing this exactly the same thing as rebalancing, but not annually, not 6 monthly, not monthly, but every single trade we do. So we are equally allocating risk at all times. That is achieving what we've been arguing for so long, which is that it improves the geometric returns at the portfolio level. So Corey's rebalancing series of tweets talks about this magical feature that occurs with portfolio maths, where provided you have a compound annual growth rate or CAGR of 0, when you compile ensembles together of uncorrelated return streams, all with this CAGR of 0, at the portfolio level, you actually get a CAGR of greater than 0. Now, the subtlety here is that to have a CAGR of 0, you actually need positive expectancy to achieve that. And the reason for that is because of the volatility drag that occurs with compounding when you get these exacerbated declines in your return stream. That actually influences compounded wealth over the long term. So the subtle point is that he said to have a CAGR of 0, firstly, you need to have positive expectancy. Now, trend followers like us, we've been saying this all along. We've been saying, hold on, we don't just have this slight positive expectancy. Because we're capturing these outliers, we have this significant beneficial asymmetry that when you start diversifying lots of different return streams, all with this beneficial asymmetry, you get a wicked wealth result at the end of the exercise under compounding. So Corey was touching on it. We've been saying this for a long time, but he was using this maths to explain it. And I think that is just a wonderful thing, and particularly because we actually do rebalance our portfolio every single trade we take.
Yeah, I thought that this was the issue. And as reading through this, I was thinking, because this is an issue that pops up a lot in why we speak a different language. And at least I speak a different language. And that is, this is one of the problems or confusions. And I'm not bold enough to get deep into this now because I have to run this by Rich first to make sure I'm thinking correctly. But I don't run into problems like that, and my way of understanding what's going on with my portfolio and my trading is easier because I eliminate percentages, and I don't ever talk in terms of percentages. And I think this is totally misleading and would confuse me and lead me down a more complex path that's so unnecessary to throw in percentages, because it's what I do is I talk in terms of ATRs. I'm adding and subtracting all the time, and always dividing some performance by yesterday or the last month or the last year. You get this, in my opinion, somewhat silly idea that if the market goes down 50%, you have to make 100% to get back to even or something like that, which doesn't add value to your knowledge base. For one thing, it happens all the time. But when the market is up $10 or down $10 and up 20 and down 20, it's 10 and 20. And then to throw in there, no, it's not. It's these percentages. And it's just so mind numbing, and it's not helping the cause. ATRs, adding and subtracting, it's a far superior way to look at your trading and your money management.
I agree, Jerry. And, Van Tarp dealt with, in terms of R. You're talking in terms of ATR. It's much more significant when we're talking in terms of what is the average loss to the average win. So talking in terms of R or ATR, that makes sense. Percentage, well, that's really just saying the degree of a move. It's not relating it to what is the average loss, what is the average win. So there's much more information in the way you're doing it than by dealing in terms of percentage moves.
Some of this problem goes back to our year-old now diatribe whether you should look at risk and everything and returns from a arithmetic mean or geometric mean. Richard summarized it very well with this idea that the portfolio does something magic. This is something that I've noticed, and I'm a firm believer in. I guess the point, and that touches on another great thread that Richard had on Twitter this week. The point that I think that the real difference between the way you guys look at the world and the way Corey and I look at the world with this periodic rebalancing is once again what to do with the correlation, because obviously you assume by sizing equally every position and not touching it, you're assuming a fixed correlation structure through time, whereas somebody that manages the portfolio and changes allocations and does this rebalancing actually wants to keep track of correlation shifting. So once again, it's a risk parameter in the system. Whether you explicitly manage this correlation, I think, is another reason for doing this rebalancing away from magical effects or not. And in your world, you don't do it because you don't believe there's an optimal correlation structure. You just don't care about correlation. You assume that everything is one, and the diversification you get is sort of a free bonus, something you get on top of it.
Well, I would just say that it's going to lead to, I would not say that's the way I look at it, but I would say it leads to the same solution, and that is I don't care. I don't care about the correlations, and I'm only looking for those outliers. And for me, it's a bit easier because I trade 200 markets, but I'm waiting for that one time in a million when heating oil may have an outlier and crude doesn't. Platinum and silver, silver and gold, and so yen and everything else. And so now we've got that yen. I'm long. I'm short almost every currency versus the dollar, and one of them. And so they're very correlated. I just don't care. Currencies are, each trade is small. The currency sector is small. So I'm cheating and not and being irresponsible and not caring whether it's correlated all the time, it's not correlated. I really just don't care. I'm waiting for that 1 in a million outlier that's going to happen. Oh, and that quote that I tweeted from Rich this morning, which was another brilliant one. I'm not even going to try to quote it because you have to go look at it. I think it's one of my most recent tweets. The more we diversify, the more outliers we get.
Yeah, I don't think it's I wasn't making a point about being responsible or not. This is a choice, as I said, whether to be implicit or explicit. But I want to go back to, that brilliant thread from Richard, who actually spoke about the threads. How thinly or how causally you thread your portfolio through looking at correlations, and that in Richard's view, and I understand why he said that. Being too obsessed with it, it introduces a level of fragility and instability in your portfolio, because unless you get absolute precision on those correlation measurements, this sort of management leads you astray, and it's something very subtle. I hadn't thought of that, and I can see why he's made the point and the comment, and hence I can see why you guys do what Jerry said. I don't care. I don't want to make assumptions or correlations. For me, everything is a one, and then if it's better than one, I'm getting that through diversification and effectively a free lunch in my portfolio.
Yeah, Bruno, look, the way I view it is that we have actually a risk mitigation mechanism in our model that takes care of adverse risk. This cutting losses short, our trailing stop. That therefore allows us to do things a bit differently to other models that have to use other methods of risk mitigation. And these other methods that don't have that mitigation in their strategies, what they tend to do is they are forced to use correlation measures, because if they are blind to the correlation that exists, when you get this positively correlated regime that is adverse to their model, they can get absolutely stung in the face. Now, trend followers, yes, we get stung in the face to a degree, but only to the degree that it goes to that initial stop. And then once that occurs, that risk is released from our portfolio and we don't have to worry about it. Now, the problem is, if people are what I call correlation focused, because they've got to be, because they've got no other risk mitigation mechanism in their model, they therefore need to really focus on this uncorrelated nature of their portfolio. However, because we've got this risk mitigation in there already, that allows us to be a bit more lax and therefore actually trade some positively correlated opportunities that, when they are beneficial to us, we get this magnificent acceleration or step up in our equity curve. So I'm just saying that because we've actually got these risk mitigation devices embedded into our mechanism, we can afford to be a bit more lazy in our concern about correlated markets and be able to exploit these opportunities, these beneficial opportunities, asymmetrical beneficial opportunities that really accelerate us, if that makes sense.
No, I was simply saying that it's. I don't think there's an explicit contradiction between using correlation or not in in building your trend following portfolio. You're still cutting your losses short, and you're still trying to let your profits run. But once again, I do see, through Richard's comments, I now fully understand why you guys choose a simpler approach, and it's one less headache having to measure and monitor these correlations, precisely because you don't care what the true number is. You're just sizing everything at entry, and then you're letting it grow if profits grow, or cutting it short if losses mount. And whether the portfolio is balanced or imbalanced from a correlation standpoint is not your problem. So makes perfect sense.
Yes, but I have said before that maybe in my situation, when money on the account deposit is limited, I think for me it's necessary to look of a probability of correlation in choosing the markets to trade. And of course, I think the more perfect way, of course, not to do so and have enough money on the account and do a fully diversified way of trading and not to don't care about the correlation. I think it's the best way, really. But if you can trade only maybe 20 markets, and it's in that situation, and I have said this before, and I have said that many times, but it's important for me personally. In that situation, you are maybe forced to choose the markets. For example, I will take crude oil, gas, and so on and so forth. So and instruments with a very high probability of being correlated. It will be maybe not the best decision, I'm sure not the best decision. And it's better to choose oil and lean hogs and orange juice and maybe milk, something that looks uncorrelated. I understand that this all correlation must not be focused on it. It's not the main thing in trading. The main things for me, it's of course, it's like Jerry said, one enter, one entry, one exit, stop loss, and so on. And of course, the main things are diversification and risk management. I said it for me personally. What are the main things in trading? But not correlation, of course. But in some situations, I think some traders must pay attention to the correlation, not to be overweighted, and try to have more uncorrelated, or maybe that looks uncorrelated and have a probability to be uncorrelated return streams.
I don't want to be too cavalier about risk and not paying attention to correlation because, as I've said, I think the most important thing for a trader to do initially is to set that risk budget, 5 units, 6 units, 4 units, 3 units, whatever it is. And because you don't want to get into a situation where you're trading too large and you're losing money too quickly. And, I have traded a stock-only portfolio before, and I did the back test, and I lived with it for many years. And just comparing, that I felt very comfortable trading 6 or 7 units of risk with the diversified, but no more than 4 with stocks only. And, you can't just ignore these correlations, especially if you're in bonds only, stocks only, commodities only. It's no good. You can trend follow those. It is trend following. It's not CTA diversified trend following. And you're taking away some of that magic. And then you see periods, not that infrequent, like January, February 2020, when all of the longs went down. It wasn't just stocks. No. Currencies, commodities, bonds, all got crushed. We're long everything. Everything went down. No diversification. And those things are going to occur. And you do the back test, and these periods are like little tiny blips. They're nothing. And but you need to protect yourself and stay in the game and maybe do a risk reduction, which leads me into the next topic I wanted to talk about, which is this tweet I tweeted from the Top Traders Unplugged with Niels and Richard. Okay, this is Niels. Several big CTAs didn't stick to their system when they manually intervened and reduced the risk / leverage in their portfolios. Okay, so I don't think that is a problem. And I think that regardless, whether it's manual or rules or whatever, my comment was risk reducing rules used during high volatility, big drawdown periods should be a part of the system, of every system, in order to stay in the game. That is your one discretionary move that you can make. And that is, I'm following my system like I always should. However, today I'm going to reduce my trades, reduce my positions, reduce my future trades for a while until the market kind of settles down and the volatility starts to get back to something I'm more familiar with and comfortable with. And I'll reduce and cut back once a year, once every 2 or 3 years. You should not have your risk so high that this is something you have to do every month or 2 or 6 months even. But in those rare occasions, and I don't think that there's any problem at all in saying, I have a rule, I want to be rules based, but this is something that has no sample size. I want it to be so infrequent because I don't want to continue to override the core system, my entry, exit, and stop loss. I think I have my max risk under control, but today I don't. And I'm going to reduce my positions 20%, 40%, whatever, to stay in the game and preserve capital. Do not ever apologize for this one magical rule that allows you to, once you complete this, now go back to following my system, my one entry, my one exit, my stop loss, because we're going to be wrong sometimes. Even if we have a brilliant system that does pay attention to correlation and its bottom line is not hunting outliers, we're really good at it. Maybe we still have to have this rule on the side to use because as Niels has said many times, the most important thing that we do as money managers, risk managers, CTAs, and trend followers is preserve capital, stay in the game in order to play another day. I think this daily dose of these stupid volatility management rules are way worse. You're overwhelming the core system. The sample size is very low. That is worse. Having rules in that particular situation is way worse than having a rule that is executed very infrequently or not even a rule. It feels like today is one of those once in a 2 or 3 year days where I should reduce my risk. I'm very uncomfortable, and I don't think it is not sticking to the system. On top of every system you have is this one rule that says, hey, when all hell breaks loose, I'm reducing risk. Maybe go flat. Then pick a period where things calm down. Get right back in there with your systems and your positions. You're doing the right thing. You'll probably choose the exact wrong period to do it. It's going to probably be the low. So what? That's your main goal, is to keep your bankroll and preserve that capital.
I agree with that, Jerry. I think there are rules that are developed using sample size, and there are golden rules, which basically are the constraints you must work within. And preservation of capital is a golden rule. That you don't need sample size to determine that. So when in those very infrequent times when your capital or your open equity, your closed realized balance capital is being threatened, you need to apply some measure to stop the bleed. That's a capital preservation rule. That's something you don't need sample size to do. But within that context of cutting losses short, letting profits run, preserve capital, they're these golden rules. We work within that space to define rules that are applicable to ensure that those golden rules are basically respected at all times.
I think the tricky part here is to make sure that you get back in when the bleeding stop, and when to get back in. Because another golden rule, or maybe it's not a golden rule, is to do every trade. So we have two golden rules where one is almost overriding the other one. So that's actually a good question. Like where do we stop the buck? As in, like, obviously this is not a frequent thing. This is maybe once in 3 years. We want to ensure that when we cut, these positions to preserve the capital, we do it in a systematic way. But yeah, you have almost two golden rules contradicting each other.
Yeah, I'm pretty proud of myself that I came up with a good answer. And it took me a long time. And I remember when, I was first taught about these rules, this ultimate money management rule. It's brilliant. I mean, there's nothing, if you're especially accept this idea that this systematic approach that you have following these rules is the most important thing ever, then what this allows you to do is to go right back to following your rules. It allows you to take these barrage of attack that you've received on your ship. You're almost ready to think you might start sinking, and then apply that cutback rule very infrequently and go right back to doing what you're supposed to do. Following these rules is sacrosanct. Now, I think this gets back to what I came up with. Okay, and so finish my thought. When I was taught this rule, I was never given a really great answer on when to go back to full speed. When do you go back? If you cut back 20% of your positions and 20% of future trades, when do you go back to 100%? And it was very shaky. I don't remember a really good explanation. So I lived with this. Okay, so here's what I came up with. Let's say you have $1 million in your account and you make 40%. So you're at $1.4 million, and your trade level was $1 million when you started. And now you're up to $1.4 million, 40%. And then you get out of your trades and you have very little open trades left, but now you're up to $1.2 million. Okay, I moved my trade level up to 1.2. I have very little open equity. Now I think it's safe to go from $1 million to 1.2. That's my kind of closed equity. Probably my total equity is 1.25 or 1.21. Okay, so that's my new benchmark. I'm going to defend that line of 1.2, my closed equity. Now, if I start losing money and it goes below the 1.2, I'll switch it to 1.1. I was premature. I have losses that I was taking, and now my line is 1.1. And I'll try to defend that level and not go too far below that. And then I will, if I'm able to do that, and then I go up to 1.5, 1.6, 1.7. When I have a drawdown from there, let's say to 1.3 or 1.4, that's my new level. So it's all about defending that closed trade equity. And then if you're able to, and you don't suffer losses, then you can gradually move it up when your open trade equity gets smaller. But if you do go below that closed trade equity, then you may have to move your trade level down a bit. Now, does not pay any attention to the drawdown from peak. That's a real bummer. I mean, that's a bummer for a lot of people. So you have to get over this whole idea of I'm here to defend equity highs, or I'm here to defend closed trade equity. Yeah, so I know that was a quick, probably confusing explanation, but to me, it was the answer.
This is the rule. It's, for me, it's the hardest to understand, perhaps due to my lack of experience. I think I first read something about it or something like that on from Ed Sakota, that his last golden rule is know when to break rules, and this is hard for me. And first, wouldn't it be ideal to design rules and parameters that you can follow on any contingency? Or are these combinations of rules and parameters that you can follow simply don't produce that much money, because you have to be too small that you won't even get any benefit when they are working, and well, you're being too conservative, let's say. And the second thing I'd like to mention is I think I understood this way of getting back on, Jerry. My only question is, do you get back on positions that are quote unquote old, that a breakout that was triggered months ago, you, for any reason, I mean, not for any reason, but due to being crushed by market, you slashed everything, and now it's time to get back. You simply put on the trades back on. Recently I've changed accounts here, and the methodology I adopted was I will not get in any old trade. I will start my breakout account. I mean my perception of breakouts as if the world was beginning today. I'm looking at new 100 day high to get long again. And well, it's been some weeks now, and I've been pretty well positioned. I've get on trends that are not that young, but for lack of a better word, but they're doing okay. So sorry for the rant, but to sum it up, do you think it's better to get back on positions as if they were triggered that months ago, risking giving back much more than your unit allowance, or wouldn't it be better to get on only new positions?
I'm going to say only new positions. So I'm going to use this new trade level and adjust the positions if they had a trade level higher than my new trade level. And then for all future positions, I have this new trade level. So I'm going to handle it all based on trade level. But I know I never go back and adjust old trades based upon new trade level, unless, it's additions or redemptions from the account. And another point I wanted to make, and I make it in this tweet, that for me, since I'm so dedicated to this one entry, one exit, and a stop loss, and based upon my proper initial choice of leverage that I'm happy with, my taking small losses, my 200 markets that I trade, I'm taking and wrapping it all around this trend following and taking these small losses and being really diversified with almost 25% of my portfolio each in currencies, commodities, stocks, and bonds, then anything other than that is outside of the system. So any sort of risk mitigation, that other than what I've just spoke of, the core system, this is outside of the system. These are non-system trades. These are trades that have very little sample size. These are not, what should I do? And well, let me tell you, because here's the evidence. You have no evidence. What you have evidence of is the core system. One entry, one exit, and a stop loss. So this reduction in size, this current positions, future positions in order to survive, to play another day, this is not part of the system. It's by definition low sample size. We don't need it very often. The core system is great. It's fantastic. So it's a guess. Regardless of how you do it, you have no evidence from some back test as to what you should do. Quite a bit different than you know exactly what to do from the back test with your one entry, one exit, and stop loss. It was born out of the back test and was evidence that implementing these rules and this core system was going to be able to make a lot of money for you and keep you in the game. It's only every now and then you have to go out of the system, do this risk mitigation, this position reduction, get it over with, go right back to the system. So now, this is not what the larger CTAs do. The core system is overwhelmed on a daily basis by risk mitigation rules, volatility management, correlation management. And I was sort of accused of saying it's not enough sample size, but I'm very careful. Well, I don't think it's enough sample size when you add in all these other types of trading. But even before getting to that, I never really try to go on record as saying it's not enough. I don't know how to count it. Sorry. I don't know how to count the sample size. I'm reducing risk, I'm adding, I'm subtracting based on vol, based on correlation. How am I counting this? I know exactly how to count an entry and an exit, an entry and a stop loss. So I think it's very confusing. Now, the back test looks amazing. I mean, it's the best. It looks so much better than mine. Therein is the difference. There's a big difference between the back test and putting sample size front and center and saying, well, the sample size is very large because I don't have very many parameters. I only have two rules: entry, exit, entry, stop loss. That's all I have. And okay, backtest looks okay. But I don't start with backtest. I start with what is the sample size. But the majority of the large CTAs, it's a morass. There's a little bit of trend following, a little bit of correlation, a little bit of vol management. And sometimes, in this particular period, regardless of all the silliness going on in that strategy, the trends are so amazing, they overwhelm these bad ideas and they end up making money. These guys would just hate me if they heard this, but that's just my opinion.
It's interesting, Jerry. You're totally right. You're totally right, because whenever we do a back test, we never accept the back test where our closed equity is being threatened. We always accept the back test where, our unrealized equity always sits above our closed equity balance. It's only in very rare instances where we'll ever see in a back test that closed equity being threatened with positive skew, the nature of our systems. So therefore, we need a rule for uncertainty. In other words, a rule when backtests don't work. We need a rule when we're going into a future where this closed equity balance is being threatened. This is something that we don't have sample size for. We don't have it in our backtest because we never accept the backtest where that is being threatened. So we need some capital preservation measure. And, in the simplest form, my method actually does involve that, because I use trade risk percentage on closed equity as for my position sizing with my models. So in other words, I'm always looking at my closed equity. I'm not looking at my total equity in position sizing. So when that closed equity is starting to be threatened, the closed equity in dollar terms reduces in value. And therefore, when you're applying a fixed percent for your trade risk, your position size decreases naturally. So you find that when your closed equity is being threatened, your position size gets lower. When it's booming, your position size is getting bigger over the course of time. So that sort of trade risk percentage application method is a way to at least minimize that drawdown impact as your closed equity is being threatened with this uncertain future. But I was interested that, I noticed Jacob Schotz on here as a listener, and in the tweet, he was very interesting because he gave a lot of food for thought in different sort of threshold measures you can use when your capital is being threatened. Maximum correlation thresholds, all of these things. These are sort of like golden rule principles that apply only in these rare instances to preserve your capital. And I'm sort of in favor of that, even though we don't have a sample size to work with. I think anything that protects our capital is a good thing.
Hello, Richard. Hello, Jerry, and hi, everyone else. I mean, if that is all right, I just would like to have a follow-up question on what.
I think I know the answer, but just to be perfectly clear.
Bruno, sorry, there was someone else speaking. I think there's an issue with your sound. That's okay.
Yeah, my connection is terrible. Sorry, guys. I'm not listening. I'll get back to a listener.
Thanks, guys. So the quick question is, so I totally agree with what Richard has just mentioned, and I'm doing a very similar thing on my own trading, where I'm cutting the position size percentage twice of the drawdown if my drawdowns are more than 10%. So my question is whether has anyone else tested this approach? What happens if you stop actually trading the system if your account equity goes down less than the 200 days moving average of your account equity? Thank you.
See, I'm not in favor of anything that tries to game or trade my system. So my bottom line is I don't want to do anything other than those system trades, but sometimes I have to, and that will be moving my trade level lower and making those adjustments on the current positions and then having that impact the future positions, and those positions will be smaller. So I don't want to do a moving average of a system that's using a moving average and gaming that. And I think that that probably is not. It seems to me also to be something that you would the tendency to want to rely upon that. Oh, how has this looked in the back test of me my trend following? Oh, it looks great. Yeah, I don't like that. I'm going to sell out to do the core trades, the breakout entry, the breakout exit, the breakout stop loss, and hopefully I'll never have to make these. And I'm not going to let anything stand in the way of me not doing my core system.
Yes, but you, Jerry, I totally appreciate what you're saying. So what I'm saying is you continue to follow up your system, but only at the backtest level. And when your account equity goes up again above the 200 days moving average, you get back and you continue to trade your system. I mean, I've never tested it. I was just curious whether anyone else has a similar idea of a little bit creative, but I totally appreciate what you said. Thank you. Cheers.
One of the things we don't want is to get in a situation where we find we're getting a margin call on our positions. So you can either implement a rule in your strategy to avoid that margin call. In other words, when your equity is being threatened, your closed equity, you want some mechanism in there to basically mitigate against that margin call. So otherwise, the broker's going to do that for you, and that's an unpleasant experience where you have no control over what they're doing, and they start sort of interfering with closing out your trades to meet the margin position. So you do need some sort of proactive means to mitigate against that event. And something like a trade risk percentage actually does that, because you actually don't need to adjust that, because you naturally find that as your capital decreases, your position size decreases, and naturally you therefore don't have to worry about, oh, when do I turn this back on, or when do I increase my position size? The percentage application actually does that for you as new outliers emerge and your capital starts building again.
And I want to add here that it's very important to be, of course, we all understand this, but I'm sure that it's very important to be consistent in such situation, especially, and of course, in general, in trading, it's one of the most important things is consistency, and in investing also. So I want to say that if you implement a rule, if you have established this rule, you must be very consistent with this, and don't do anything that can get your system to a discretionary way.
I'm trying to be devil's advocate. So we're talking about sample size, and one of the questions or one of the observations, like it seems there is a reason for needing the ability to count the sample size, right? Like, why not say I can't count it, but it's large, so that's fine. Like, why do we need to count the sample size? Um, and then my second question is more regarding the trade level versus closed account equity divided by percentage, or taking a percentage of that. Like, just for my clarification, what's the difference actually between the trade level and saying you're taking closed account equity and percentage? Because that's it.
Well, personally, I think there are things we call golden rules, and then there's things that relate to sample size. So the golden rules ensure that the strategies we deploy are asymmetrical in nature. So, and also that we can apply that rule in perpetuity. So in other words, a golden rule will be something like, we must be systematic as opposed to discretionary. That's a golden rule. We must cut losses short and let profits run. That's a golden rule, because it's not explicitly saying how short and how we do this. It's a golden rule. There's a golden rule such as preserve capital at all time, so that we can be in the game at all time. That's a golden rule. Then there are rules that we use sample size for to determine how far we cut losses short, how we let profits run. Things within that framework of those golden rules is what we use sample size for. And we use sample size to validate that rule. In other words, We're not using, a small sample to ensure that we're achieving that outcome. We're actually using as great a sample size as possible to ensure that that sample size, the rules defined by sample size, fit within those golden rules of our framework. Because in developing this framework, which is like the logic of the model, that logic is imperative for our trend following. This asymmetrical asymmetry, that is fundamental to our entire game. Positive skew, asymmetry, all of these things, that therefore allows us to achieve this wealth outcome at the end. But the rules through sample size are ways to validate that the things we do within that context are valid and are supported by a huge sample and not simply whims or discretionary decisions based on a very small sample within that context.
And if I could just add, I think I had this discussion going back and forth with somebody, and then they said, I was quite wrong, because the sample size with this vol management and correlation management is quite high. It's way more than one entry, one exit, and a stop loss. Totally true, right? They have way more trades than I do. However, therein lies the problem. You have to put these trades in their own bucket. So the one entry, one exit stop loss that may have 5,000 trades, that's not a 5,000 trade sample size. That you count up the sample size of the entry exit, that's one bucket. The sample size for the entry stop loss, that's another bucket. So I've got two buckets to put my trades in. I can't add them together. Now, how many buckets do they have? Correlation, vol management, multiple exits. So multiple exits are a major problem. If you have an exit that says, well, exit at the 50-day low or the 100-day low, or exit at the 10-day low if the profit is really large, well, you can't put those in the same bucket. And there's a lot of that going on too, to lock in those profits and not give back too much. People slice and dice the trades based upon their profitability or the distance to the exit. The one exit should be one exit, but it becomes multiple exits. So counting these sample size is, look, you can get on podcasts, you can listen to Spaces, you can listen to Clubhouse. Nobody's talking about their sample size. They don't want to talk about it.
That's exactly right, Jerry. Those buckets you're talking about, really what that's saying is that as you have smaller and smaller buckets, you are increasing the complexity in your model. And what you are actually doing is you are over-optimizing that model based on a narrow sample size per bucket. You don't want that. You want intense, long, great sample sizes to ensure that you've got maximum degrees of freedom in your model, as opposed to increasing the level of complexity for complexity's sake. And through that process, we therefore ensure that our models have loose pants, because a huge sample size, giving lots of degrees of freedom, require very, very large buckets.
And I think that for me personally is very important, because I did a lot of backtests, and I want to say that it's very important to have not only a sample size of 5, for example, 1,000 trades, 10,000 trades, but I'm sure that it must be a sample size, a backtest from different environments or different market regimes. Because, for example, if we have in short-term space, if we have a backtest of 10,000 trades that we have seen that occurred during the year, it will not be as valuable like we have a sample size during maybe for 5 years. Because I have seen that in changing this environment, changing regimes, we can see very different results. So our backtest in a long term, so I want to say that if you have 5,000 samples from a long-term system, it's probably more valuable than a 5,000 trades from a short-term system, because it's different, we can say different regimes during the test period.
That's exactly right, Oleg. We can bring this discussion that we're having right now back to that earlier discussion we had on regimes. So if, for instance, you optimize your model for a single regime, that's exactly what we don't want. So as classic trend followers, we're looking for these transition events between regimes, and this therefore demands that our sample size is spread across as vast an array of different regimes as possible, so that we can assess the degree of how well our models cope with these transitions between these regime periods. So a lot of people use, sample size as a means to validate their models. But the reality is it's more than just sample size we're after. We're after a backtest over an extended array of different possible regimes, because this tells us how robust our models are going to be when we meet these future regimes, which we haven't seen in the past, and we have these transition events between these future regimes. We want a robust model that can sort of navigate across regimes, between regimes, or the transition events. And that's crucial to our need for extensive sample size for our modeling.
So it's almost deploying the KISS method, keeping it simple, making sure that you don't have too many degrees of complexities that increases the different paths that the strategy will take on based on those. But just keeping it simple, making sure that the rules you have is robust, and keeping out the complex rules that's not adding much positivity to the strategy almost.
Exactly.
I think,
and the way to look at that is that, if we define, a historical market price pattern, we might see that actual price pattern followed a polynomial function. That's just, it's not a straight line. Or we had this very sort of, this oscillating past history, this price pattern. So if you want to, with fidelity, capture that, the nature of that past regime, you need many variables in your model. So as opposed to a straight line, y equals, m plus x plus whatever, you now need a polynomial function. What that does, that polynomial function, is adding more variables to your model, and it's reducing the degrees of freedom. It's saying that it's got to be explicitly curve fit or over optimized for that regime. That therefore means that your model becomes really specific to that historical regime, and it becomes fragile when that regime changes. So we want sort of an anti-fragile model. We want something that doesn't go underwater when we find that our regime changes. Therefore, we need a very sort of a loose pants, very simple model with few variables to navigate as many different regimes as we possibly can.
Yeah. So loose pants equals robustness again, just to reiterate. And if you have, tight pants, that's the opposite. It's just like the thing that's coming to mind is just like a fish net. If you want to catch a lot of fishes, you have a wide cast net, and if you just want to get one specific one, you just have a smaller net, but that means that you will catch way less fishes out there.
Exactly.
Hi guys, can you hear me?
Yep.
Yeah. Okay. So yeah, I have a comment. I was actually surprised to hear that there is this level of discretion in terms of sizing and risk allocation in extreme cases, let's say once a year or once every 2 years, in a community which is very religious and consistent about having rules and not letting emotions drive your decisions. And to me, the way I understand it, trend followers capitalize on the emotions of fear and greed when uncertainty is huge from the rest of the market, because they're rigorous with their rules and they're the only cool ones in the market, and that's when they make the money, when the fat tails happen and the rest of the market lose their brains and souls in fear and greed. And then I hear that, oh, but then when things are really bad, even trend followers succumb to emotions and they have to do something which is outside of strict rules and of their rules. For me, I do trade and I'm a trend follower, and I do have risk management and capital preservation as part of the system. And I think the way to increase the sample size for the risk management rules on a market sector and on a portfolio level comes from normalization to volatility, which is what Jerry and Richard are against. So the way...
No, we're not. Just to put that into context, we apply ATR-based mechanisms on entry to normalize volatility across any market. So what that means is that we trade the same risk bet to any liquid market based on ATR-based volatility at the time of entry. What we disagree with is tampering with that volatility once that bet is placed to the exit of that trade, because what that does is it compromises our letting profits run statement.
Okay. Yes. So I think, yes, I agree that is the basic difference between me and you. But the difference, I think, is mainly, and when you're referring to sample size, I know that my sample size is also very large in a volatility normalized space. Your sample size is large in a notional space, in a dollar space. I can map your dollar space into a volatility normalized space and have the exact same sample size. One. And then second question I have as a comment, if you have sample size of 5,000 trades, but 4,000 and like 4,900 trades are pretty much little pluses and minuses and zeros, and most of the trades were made in, most of the profits were made in 100 trades out of those 5,000. Would you consider to have a system with a large sample size?
I mean, I would. Of course we would, because what the example that you gave is perfect. And we continue to talk about, independently of you, we continue to talk about our large sample size, because the sample size is determined by the entry and exit rules and parameters, and not, we don't sort the trades based upon the size of the profit.
Okay,
Now,
so let me push it to an extreme.
I do want to say one more thing, that just a comment about something you said at first, which is that I don't think that, I wouldn't say that when I have to step outside of the system and reduce my risk by reducing my positions and reducing my future trades, that this is, as you called it, an emotional decision. I'm freaked out. I'm very afraid. Now I'm going to do something emotional, non-system-wise. No, I don't. I think it's a recognition that it's possible that these, as great as these systems have looked in the past, and on the back test or in our experience, that they're not a religious experience that I'm going to put all my faith in, and that it could be possible that I should be a little conservative sometimes and reduce risk. So it's purely just a money management and a cold-blooded attempt just to stay, not to lose too much capital and have too large of a drawdown, even though the systems are designed themselves to not really need this type of risk reduction, but it is possible that they may, and I would disregard the rosiness of the back test as it relates to their ability to withstand really bad periods.
Yeah. Okay. Yes, I understand that, Jerry. One last question. So let's say you say 100 trades are most of the profits, and the 4,900 are okay, plus minus zero. What if 3 trades were where all the profits were made out of 5,000. Would you consider a sample size to be large?
Look, I've got an answer for that. So, yes, we target outliers, and outliers in our vocabulary might be only 5% of our trades. But at the time we enter a trade, we can use the sample size associated with 95% of the balance of data. So that means that we are explicit about how we enter a trade using sample size. But once we commit our bets, we're working on the principle that this trade that we are entering is an outlier, and there is no precedent for that outlier. There is no sample size we can work out to tell us how to trade that outlier once we've committed our bet to that outlier. So therefore, we don't adjust our positions during the course of that event, because we believe that if this is that 5% anomaly in our data sample, there is nothing statistically that we can infer about it in terms of dynamically adjusting our position size based on any form of statistical certainty. And so that's why, we are very explicit about a rules-based approach to determine when to enter our trades and what position size to apply to that, because we've got this 95% of data to confirm that. But then once we've committed to that bet, we're hoping that it is the outlier, and therefore we just don't touch it because we know little about that outlier, just that we need an asymmetrical model to capture the fruits of it.
Yep. And what would you say if there was a volatility normalized system which normalizes for volatility during the trade, which actually distributes this distribution of profits from, let's say, from 100 trades and expands it to 1,500 out of 5,000? And on a volatility normalized space, the same. What I'm saying is, if there was a way for you to capture fat tails and still volatility normalize, but then expand the distribution of profits out of you have 5,000 samples, I have 5,000 samples. You make profits from 100 trades, I make profits from 1,500 trades. My profits are from 1,500 trades. Which one of those two would you say has a larger sample size and a larger statistical significance?
Yep, I get your point, but it comes down to if you can have some statistical validity in that process during that outlier that allows you to maximize your profit through some form of normal, position sizing dynamic, I'd say, yeah, well, you've won. However, I'd say it can't be statistically validated.
Well, no, of course I cannot maximize the profit on your 100 trades, which you're proud of. But what if the lesser profit on those 100 trades balances out with the bigger profit I make on the 1,200 other trades on which you kind of break even? That's what I'm saying.
Yeah, that could be one instance, but will that be the same with every single outlier? When we're talking about mapping a statistical space to an outlier, we don't find that there is any regularity in those outliers, so we can get some consistent map of all available space states. So in other words, we're saying each outlier is different and statistically different, and therefore we can't deploy any statistical inference or method to get any benefit out of multiple outliers as opposed to a single outlier.
Okay.
There's a big difference. Sorry to interject.
Thank you, guys.
I think you and I are very much aligned on this, and I'm trying to understand what I understood from Richard and Jerry through previous conversations. They reject this approach because they say, what you're doing, you are sort of, prematurely exiting, even if in small parts, but you're not fully allocated to the outlier or the potential outlier that we are after, and therefore doing that minimizes your terminal wealth. I sort of, I find retorting to this point statistically impossible because it sort of, requires proving something that can't be proved. But, I'm very much of your own opinion that, having a volatility-based redistribution and following continuous signals achieves a better terminal outcome, even if you have to sacrifice individual trades. So, I sort of, bow to Richard's and Jerry's point, which is, our best trades will always be better than yours. And I can't quite bridge the, the gap by saying, yes, but, my portfolio is always going to do better than yours. And the reason being that, and you probably know this very well, when you start, looking at modeling correlations and volatilities, measurement becomes very delicate, and a tiny mistake propagates either through, algebra and so having
No, absolutely. I wouldn't.
and stuff like that. So
yeah,
I wouldn't. It's a very
include.
good point, but it's difficult to argue. So
absolutely, I wouldn't include.
It's
I would
difficult to
take
convince.
correlation out. I would take correlation out of the discussion. I think
Yeah, but it's the
volatility
same metric,
normalization.
right? Volatility is the diagonal, and correlation is off diagonal. So they don't want to look into that matrix, and I respect their choice. I think it's very difficult to argue with them, especially because Richard is very eloquent, Jerry is very skilled and successful. It's very difficult to argue and convince them. That's their approach. And I marvel of what they say. And
my goal is not to convince anybody into anything. My goal is to learn something, and I really appreciate Jerry's and Richard's consistency in their argument. And this discussion is just for learning. It's not to persuade or convince anybody else to do something different. At least that's how I approach these spaces and these discussions. This is mutually beneficial, and with the desire to learn.
Let me sign off here, because I need to get on to something else. But this is fascinating. We need Absolute and Bruno back, because this could be the first time that volatility management wasn't brought up by Richard or me. But, it inevitably is going to get back to this, as much as Niels gets tired of it, but it's just where the fault line is. And there's so much more to say tomorrow. Next week, Friday, next week, 8 a.m., we'll do it again. But I really hope that Bruno's one of our best friends, and Absolute has so much to add. This is a fascinating conversation. I wish we could keep going. Anyways, thanks, everybody. See you next week.
Cheers, everyone. Bye.
Thank you.